Hi, my name is Brian. Welcome to this journey through space. Today we are going to study the chapter, which is Types of Insurance Products. In this chapter, we'll explore what different insurance products are, how they work, the economic roles they play, and how they shape financial security in both personal and business contexts. Think of insurance as our shield against unexpected storms, whether those storms are real, like hurricanes, or metaphorical, like sudden job loss or medical emergencies. Course overview and learning objectives. We begin by setting our learning goals. By the end of this session, you should be able to understand the fundamental principles behind each type of insurance product. You will analyze their economic implications, how they impact both individual households and entire economies. We'll also evaluate how different insurance categories help mitigate risks, whether those risks relate to life, property, health, or business operations. This foundation will prepare you for practical applications from personal finance planning to market analysis. Insurance. The foundation. Insurance operates as a financial mechanism that redistributes risk among many people, reducing the financial impact of unpredictable events. Instead of one person bearing the entire loss, everyone contributes a small amount to a pool that covers the unlucky few who face losses. This transforms individual uncertainty into collective predictability, which stabilizes both personal lives and the economy. Without insurance, risk-taking, such as starting a business or buying a home, would be far more dangerous. Modern economies rely on insurance to balance safety with innovation. Overview of types of insurance. There are many insurance categories, each designed to address a specific set of risks. In our study, we will focus on life, health, motor, property, liability, marine, fire, and microinsurance products. Each category has its own market structure, pricing mechanisms, and regulatory environment. We'll examine how these differences matter in terms of customer needs, company profitability, and economic outcomes. This overview will serve as our roadmap for the rest of the chapter. Life insurance. Life insurance is about protecting loved ones financially when the policyholder passes away. Products like term life provide pure protection for a fixed period, while whole life combines protection with lifelong savings. Endowment policies mix protection with a maturity payout, and unit-linked plans invest part of the premium in financial markets. On a microeconomic level, life insurance smooths consumption over a lifetime and transfers wealth across generations. On a macroeconomic level, it is a major source of capital formation, funding government bonds and infrastructure. Health insurance shields individuals from the financial burden of medical expenses. It can take the form of fee-for-service plans, managed care networks like HMOs and PPOs, or consumer-driven plans with savings accounts. Public systems like the NHS in the UK or Medicare in the US provide coverage through taxation, while mixed systems combine mandatory basic coverage with optional private plans. Market challenges such as adverse selection and moral hazard create inefficiencies. Addressing these issues is crucial for improving healthcare access and affordability. Motor insurance. Motor insurance protects against losses from vehicle accidents, theft, and damage. Third-party liability is mandatory in many countries, ensuring victims are compensated. Comprehensive coverage adds protection for your own vehicle and personal accident coverage for injuries. Risk-based pricing takes into account the vehicle type, driver history, and location. With the rise of telematics and autonomous vehicles, the industry is undergoing major shifts in how premiums are calculated and liabilities are assigned. Property insurance. Property insurance covers losses to physical assets, whether personal homes or commercial properties. Homeowners insurance typically covers the building, contents, and liability, while commercial policies protect business assets. Factors like location, construction quality, and safety features influence premiums. Climate change is increasing risk exposure, potentially tripling premiums in high-risk areas by 2050. This makes property insurance a key player in climate adaptation strategies. Liability insurance. Liability insurance protects individuals and businesses from claims of negligence or harm caused to others. Professional liability, also called errors and omissions, covers professionals like doctors and lawyers. Public and product liability applies to businesses serving customers, and directors and officers. Insurance covers corporate executives. Over the decades, liability markets have expanded globally, adapted to digital and climate risks, and faced increasing litigation rates. The future will see new liability categories linked to ESG disclosures and AI governance. Marine insurance. Marine insurance is the oldest form, originating in the 17th century at Lloyd's of London. It covers ships, hull insurance, cargo, marine liability, and offshore energy facilities. Although it started with sea transport, it now covers goods in transit by air and land as well. This category has a long history of adapting to global trade changes. In a globalized economy, marine insurance ensures the smooth functioning of international supply chains. Fire insurance. Fire insurance provides financial protection against damage from fire and related hazards. Basic coverage addresses direct fire and smoke damage, while extended coverage includes lightning and certain disasters. Business interruption policies help companies recover lost income during repairs. Although fire coverage is often bundled with property insurance, standalone policies still matter in high-risk commercial environments. Modern risk assessment tools now determine premiums more accurately than ever. Microinsurance. Microinsurance targets low-income individuals, offering affordable protection with simplified terms. It often uses community networks for distribution, allowing rural and underserved populations to participate. Products cover health, crops, property, and life risks. Beyond protection, microinsurance fosters economic inclusion by integrating more people into the financial system. It can be a powerful tool for poverty reduction and resilience building.